The broadcast is now starting. All attendees are in listen-only mode.
Hey, good morning, everybody. It's Thursday morning, July 21st. Thanks for taking the time out of your schedule to join us today on this special presentation. My name is Michael Baltos, and today I'll be talking about trading the order flow, professional trading strategies that, professional traders use every day in the market. So I'll just let just turn 10 o'clock. There's still some people coming into the room. I'll just give them a chance to come in. But, really what I just want to stress is there's so many different ways to approach the market and trading. Order flow is the way that I approach the market, and it's the way that I was taught since, I started my trading career on the trading floor at the CME in the early 1990s. And, it served me well through the years. And, I've been able to make a nice, comfortable living through trading. And, my goal for you today is, for you also to understand the order flow. So if you've been trading for any length of time, you know that there's a vast amount of information out there, right? It can be overwhelming trying to sift through it all and figure out what is relevant to you and your trading style. Like I said, everybody has their own trading style. No two people trade exactly alike. And that's why I'm glad you took the time to join me on this quick training session. And today, what you're going to learn is you're going to discover how professional traders use the order flow to their advantage. I'm going to teach you how to identify when there's a change in the order flow and how to use order flow to spot opportunities in the market, right? That's really the whole point of using order flow, is to spot those opportunities, especially the opportunities that people who aren't using order flow just don't see in the market. So if you're new to one of my presentations, I've been partnering with Investors Expo for a while, but if you're new here, just a brief background on who I am. Like I said, I started my trading career on the CME floor in the 1990s with Dean Witter Reynolds. When electronic trading started taking off, I left the trading floor to go work on their off-the-floor trading desk, trading, Globex, which was the CME, Project A, which was the Board of Trade, NYMEX, COMEX system, which was called Access, as well as all the international exchanges, the exchanges in Asia, Singapore, Japan, um, Europe, the Life, DTB or Eurex, as used to be called DTB, but the Eurex exchange, as well as all the exchanges around the world. And it really opened my eyes up into how the markets really move, as opposed to being on a trading floor. You're just focused on one and maybe two markets. After Dean Witter, I joined the trading desk at EDF Man in Chicago, the macro futures trading desk. And after a couple of years, I joined Commerce Bank. I was a licensed Eurex trader there. I was trading as one of only a handful of people that were legally allowed to trade Bunds, Bobble, Schatz, DAX, Euro stocks in the U.S. on the actual exchange terminal. After Commerce Bank, I took some time off. I traveled the world for about 6 months, and I joined the trading desk at Cargill in Chicago. This was, a big, if you're not familiar with Cargill, it's a big commodity trading firm. It's a privately held firm, but if it was a publicly held firm, it would be, it varies from the first or second largest firm in the United States, privately held. If it was publicly held, it would probably rank about eighth or ninth. And, they account for about 30% of U.S. grain exports, about 25% of meat exports, but they trade everything there as well. After Cargill, Cargill sent me out to Singapore to set up a trading desk when the exchange was closing down, and that's how I ended up working for J.P. Morgan in Singapore. I spent 8 years there as vice president of futures trading. And after my daughter was born, I left J.P. Morgan to basically trade for myself, right? Because I realized, I know how to trade. I know what matters in the market. I don't need to spend 12 hours a day in the office, right? I could do this for myself. And I started writing a book on trading. It was called Trading the Order Flow. And eventually, the software that I was using, really wasn't that robust. It was just a basic charting software of plotting the order flow. And so I started my own company, theorderflows.com, which I incorporate my forms of analysis into the order flow. So that was 2015 that happened. So we've been going on 8 years already. And again, I created my own software because the software that was out there just wasn't good enough, right? It was just basic, right? But software, computer programs exist to help you become a better trader. Now, The reason I talk about that is because, the charts that I'm using in this presentation are generated from my Orderflow software. Okay, but what I'm teaching you can be used with any software out there. Okay, so hopefully you can come away, if you're not using, my software, if you're using, the systems, your trading systems native order flow footprint software, you can apply what you're using today. And again, creating the software, it's been a big help for a lot of traders, right? Traders are, writing to me, posting on social, saying, your software allows me to see who's in control of the market clearly, right? And that's the whole point, right? You want to be able to see clearly what's happening in the market, and more importantly, understand it. And that's where order flow comes in. Now, brief disclaimer, trading does involve risk. Only risk capital should be used for trading. Just bear that in mind, right? I mean, we're all adults here. We do understand the risks involved. So how professional traders use the order flow to their advantage. Now, as a trader, I'm always looking for ways to get an edge on the competition, right? And the one tool that I have found to be very useful is order flow, right? So by understanding the order flow, I'm able to make better informed trading decisions. And, this goes all the way back 20, close to 30 years of market knowledge, right? When I was on the trading floor, on the exchange floor, you would have access to that order flow information, right? That's why people paid hundreds of thousands of dollars for exchange memberships, right? So they can see the flow of orders coming into the market and trade with it, trade against it, right? That was the information that was available if you're on the trading floor. If you're off the trading floor watching ticks on a screen, you wouldn't be privy to who's buying and who's selling and how strong that buying and selling was. So order flow is simply a way to organize the trades that happen in the market. And by tracking the order flow, traders are able to see which way the market is moving. But what you want to look for is what the aggressive traders are doing in the market. Because after all, that's what causes the markets to move, is the aggressive trading that's taking place. Now remember, markets trade in a two-way auction. Okay, there are traders bidding, there are traders offering. A market is 5 bid at 6, right? You have bidders and you have sellers. I mean, people offering it out. So when you have people offering and bidding, these are passive traders. But if you just have bids and offers, the market's not going to move, right? I mean, the market could be 5 bid at 6, but unless someone buys it at 6, the market's not going to start to move higher, or it's not going to move lower if someone doesn't sell 5s. You need aggressive traders, right? The ones that cross the bid offer to get the trade done are the aggressive traders. The traders who buy the offer or the traders who sell the bid are the aggressive traders. And if you look at a dome, right? I mean, you see prices on the offer and above, see bids on the current bid level and below. These are the passive buyers. People working a bid and below are passive buyers. People working the offer and above are passive sellers. The trader that crosses, currently this market's 39.53 and a quarter, offered at 53.75. For a trade to happen, someone has to go up and pay 53.75, right? That is being an aggressive buyer, or an aggressive seller is someone that would sell it at 39.53 and a quarter. That is being aggressive, right? Because if we're just bidding and offering, the market's not going to move, right? It'll just stay stagnant there, right? Until someone goes in and buys the offer. And that's an important concept. People don't realize the distinction between aggressive trading and passive trading. Now, when a trade takes place, where does it show up? It shows up on the time and sales, right? And it's from the time and sales that you're able to get more information. I mean, you'll see you'll see different colors on the time and sales, right? You'll see green numbers, you'll see these orange or red numbers, and that's telling you how it traded. Someone aggressively sold the bid or aggressively bought the offer. Now, all that information can be formatted into an order flow chart, right? And that's going to start giving you more information. It's going to tell you how much volume traded on the bid, how much volume traded on the offer. And once you start looking at that, then you could get further, right, in your analysis, right? You could see, well, okay, in this bar, there was net aggressive selling, or in this bar there was net aggressive buying, or even things like where the volume is sort of building up in a bar, right? Is it appearing sort of in the middle as normal distribution, or is it appearing on the edge, at the high or the low, which could indicate price defense, or when you hit a high, is there very little volume, right? I mean, like minimum volume, like one contract, information like that. There's just so much little bits of information that you as a trader can take away and use in your analysis. Because when you format the data into an order flow footprint chart, you can see not only the volume traded in the auction, but you can determine the aggression that's taking place or not taking place. All right? Imagine, if it's like trying to cook without a thermometer, right? You don't know how hot the water is, right? I mean, you can see if it's boiling, but, turn on your oven. You think my oven is on, but if you don't know the temperature inside, if it's not hot enough, your meat's going to take a lot longer to cook, right? If you need to, bake the chicken at 400 or 350, but you don't know that the temperature in your oven is only 250, it's going to take a heck of a lot longer to cook. Or again, if you don't know it and you take out your chicken thinking it's cooked, you bite into it, it's still frozen inside. So that's understanding the aggression, what's happening inside the candle, so to speak, is going to give you an edge over other traders. And a normal candlestick, it just leaves out that information. It's just not there, right? You see um, the open, the high, the low, the close is very two-dimensional. Well, I wouldn't even say two-dimensional. It's more of one-dimensional. Okay. I mean, people like to say, well, there was price rejection here because they see price traded down and came back up. Okay, well, is it really? I'm going to show you some examples where, these bars like this, people say, well, there's price rejection and, the market went up. Well, it's not, right? Sometimes there's heavy volume that's being traded down here. And if you can see that there was, heavy volume, there's price support there, right? Someone is defending that level, and you could expect the market to put in a stronger move. So what's the information that you get in the order flow that you can see on a footprint chart is it's a lot, right? You're getting delta. Now, delta is the difference between aggressive buyers and aggressive sellers in the bar. Max delta, again, on a bar by bar basis, max delta is the strongest reading of delta in the bar, meaning, the highest reading of aggressive buyers in the bar. Min delta is the opposite. It tells you the strongest weak, I don't want to say the strongest weakest. It's going to tell you how weak the I'll say even how weak the bar was. It's going to tell you how strong the aggressive sellers were in the bar. It's going to be a negative number, right? So it's going to tell you how strong the aggressive sellers were in that bar. Now, cumulative delta is, every bar has a delta. Cumulative delta is sort of the running total of delta for the trading session up to that point. So it could be, minus 10,000, meaning, usually if a market is been selling off all day, you're going to have negative delta. If a market's been rallying all day, you're going to have positive delta. But even within that, you could start getting inferences in the market, like is, even though we're making a new high, is cumulative delta still rising or is it decreasing? Right? You have a divergence in cumulative delta versus price. That's a nice opportunity to potentially get short. Now, point of control is the price level in the bar with the most volume. Now, some people refer to it as commitment to traders. Some of the earlier works on order flow, you do see some people talk about COT, but point of control is the price level in the bar with the most volume. And, that's the term that's used more often. Now, imbalance is also important, right? Imbalances you can see in the order flow in a bar, in the two-way auction, right? And that's very valuable information, seeing when a market is out of balance, right? If you know that the market is, it's 5 bid at 6, but you have an imbalance trading at 6, then chances are it's going to quickly go to 7, right? And if it's still imbalanced between 6 bid at 7, meaning more aggressive buyers at 7, chances are we're going to go to 8, right? So it's important to know where these imbalances are coming in. And think of it like this. Think of imbalances like this. If you got kids, I mean, nowadays, you could shop on Amazon, but in the old days, right, you go to, Christmas time, there's always the hot toys, and there's always big demand for these toys, and you find yourself going around to different toy stores finding it, but a lot of places are sold out. That's a sign of imbalances in the market, right? Because you have very aggressive buying going into the holiday season for a certain toy, right? But everywhere is sold out, right? And you do find it at a place, and it's like 50% more. Like, why is why is the list price is $29.95. You're selling it at $39.95. Well, yeah, it's because the demand is greater, right? When you see big demand, you tend to see imbalances, and this is all information that is coming out of the marketplace, right? That you're seeing in the time it sales. But I said, unless you have a way to format it, you're not going to be able to understand it. So what do you think is more useful, knowing when and where aggressive trading is taking place, or only knowing the last traded price, the open, the high, the low, and the close, as you would see on a normal candlestick chart? So for example, right, this is E-mini S&Ps, right, MES. Now, people ask me all the time, Mike, what is better, to trade MES by itself or trade MES off of the big contracts, use the big contracts? So you could do both. Personally, I think MES has got enough volume. You can trade it by itself. Granted, it will move in conjunction with the big S&Ps. But if just getting back to imbalances, right? Imbalances are a sign of aggressive trading. So if you have buying imbalances, okay, in a footprint, it's going to be red numbers in the footprint. Remember, the footprint tells you the volume that's traded on the bid versus the volume that's traded on the offer in the two-way auction. So if you see red numbers in the footprint, you have aggressive selling. If you see blue numbers, that's telling you you have aggressive buying. So as this market is just sort of going sideways, it makes this little push lower. You're seeing some aggressive selling. Okay, then the market sort of bottoms out here and starts rallying, and you're seeing aggressive buying. You're seeing the blue numbers in the bar. You could even take it a little step further. You could be watching the delta, right? Because delta is the difference between aggressive buyers and aggressive sellers in a bar. And as the market starts rallying, right, you're going to be looking for positive deltas, right? And preferably getting stronger. Just as this market that was going down, you're seeing negative deltas. But what is interesting, right, as this market is sort of coming off here, you got negative delta, strong one, -700, negative delta, -400, negative delta, -91. Okay. But then the aggressive buying starts showing up. Now you're seeing positive delta. So not only was the aggressive selling getting weaker, but as it's turned, you're seeing the aggressive buying picking up, right? And this is information, again, it's available to you as a trader. It's whether or not you want to use it, right? I don't understand why traders don't want to use it. I mean, it's there. Okay, here's, yes, again, right? Market, this is just this morning, right? Market sold off, bounced up a little bit, sold off again, right? And if you can see just which way are the aggressive traders going, okay? You got aggressive selling, 1, 2, 3 here. There's one green bar with some aggressive buying coming in, and then aggressive selling, this bar, this bar, this bar, this bar, this bar, this bar, right? You can see the negative delta getting stronger. It went from 18 to 94 to 415. Right, even here, right, market sold off, bounced a little bit. You got some positive, this little pocket of positive delta as the market bounced. Then it corrected itself and it came down. Now, where it gets interesting is, when you start looking at bars of order flow, right, and you start looking at imbalances, you can start to group, the imbalances together, right? When you're seeing bars that have multiple imbalances, that's a sign of, aggressive buyers coming out right now. Okay, so this bar here's got 1, 2, 3, 4 buying imbalances. This bar's got also 4. This bar's got 3. This bar's got 5. This bar's got 5. But at the same time, when you're watching order flow, sometimes it gets a little tricky to recognize this stuff because the market's trading, it's happening so fast. And there are easier ways to use it, right? Trading should be very visual. I mean, we're very visual people nowadays because of social media. We're scrolling through Instagram, Facebook, watching, YouTube shorts, TikToks even. Um, we want to be able to recognize something that we want to pay more attention to very quickly, right? When you're watching, these little short TikToks or whatever, after the first couple seconds whether you want to watch it or not, or whether you just scroll. And if you had a way on your chart to quickly recognize where multiple imbalances are coming in a bar, that's going to be useful to you. So you can see this market sort of coming off here. Okay, then you got a bar here, right? And with those multiple imbalances, this is the same chart as this one, right? But what my software does is it puts a box around it just to highlight it to you to pay attention, right? It's not a trade signal. Oh, you got multiple imbalances, you got to get long, or you got multiple selling imbalances, you got to get short. No, it's something to draw your attention, pay better attention to the market. The market was selling off. Then I see quickly I got a bar with multiple buying imbalances. Okay, now I'm going to take it a little step further and analyze this market. Right? Okay, didn't go anywhere. Fine. Market starts selling off. Again, I got another bar. This time it's multiple selling imbalances. And another bar, multiple selling imbalances. Okay, I know now aggressive selling is obviously in control. I can see the imbalances taking over this market. I can see the negative deltas. Yeah, I could be short. Okay. Now, where it gets interesting is when markets make highs or lows, or swing highs or swing lows, right? This is MES yesterday, right? We coming down hot into this low. Then you hit that low, you bounce, right? You turn, you got that big bar up. But more importantly, you got 1, 2, 3, 4, 5, 6, 7 buying imbalances in this bar off the low. What do you think the market's doing, right? There's aggressive buyers. Aggressive buyers are the ones that move the market. Well, you want to trade in that direction, right? You're not looking to get short here thinking it's going to come back down. Why not? It's because the aggressive buyers are there. Okay, so that's an edge that you're going to have in the market over other traders who don't know that there's aggressive buying. They're just guessing that there's aggressive buying. Oh, I got a big green up bar. There must be aggressive traders in there. Okay, how many times have you seen a big green up bar off a low, then the next bar, big red down bar down into new lows, right? You need that information to help solidify your trade idea. This is corn, okay? Again, whether you're trading S&Ps, crude oil, currencies, bonds, even corn, right? A very stale market for a lot of people that aren't interested. But I'm just showing you how the same things apply into other markets. This market's just going sideways here, right? It's going nowhere. It's going nowhere fast. Then what happens? You get the bar with the buying imbalances in there. 1, 2, 3 buying imbalances, and then it takes off, right? People say, well, it didn't really take off. Well, in corn, this is what? It's a $150 move that happened in about 10 minutes, 15 minutes. Okay. So, the same things that you would use on any market can be order flow. The nice thing about order flow is it transfers from one market to the other, right? Forms of analysis, whether you're trading corn or Apple stock or, Tesla or S&Ps or, wheat or anything, buns, right? You'll be looking for the same type of things happening in every market because, auctions trade the same, whether doesn't matter what market it is. Now, the next part I want to talk about is how to identify where there's a change in order flow, right? Traders are always looking for an edge to give them advantages in the market. And one of the best ways to get that edge is by recognizing for changes in the order flow, right? I just showed you the imbalances, right? That is one way you're going to see changes in the order flow. Now, when there's a shift in the order flow, it's going to signal a change in market conditions that can be exploited for profit. Now, there are a few ways to do this. One is to look at price action. Okay, price action has got nothing to do with order flow, but when you start combining price action with order flow, it's going to give you an extra edge over everybody else. So if prices are moving higher on increasing volume, right, we know this. This is Granville 101. There's a good sign that strong buying pressure in the market. Conversely, if prices are falling on increasing volume, that indicates a strong selling pressure. Yeah, of course, we know that. But there's other ways to gauge order flow, and it's through the use of traded data. It's going to give you a direct look at the buyers and sellers in the market. So again, what are these areas of market generated information? Well, there's delta, there's max delta, there's min delta, point of control imbalances, value areas. I didn't talk about value areas yet. I'll get to that a little bit later. But this is information based on what is trading right now. Another reason I got max and min delta highlighted there is because I'm going to show you how to use that internal data. So just to reiterate, max delta is the strongest positive delta reading in a bar. Min delta is the strongest negative reading of delta in a bar. And think of it like this, right? Think of it like getting on a scale, right? And seeing how much you weigh. Excuse me. We know that, if we hit a certain level on our weight, it's very high, right? We want to ideally keep below that. And that's what max and min deltas are. They're basically, measurements of strength of aggressive buying or strength of aggressive selling in a bar. All right, so max delta, min delta, how to use it? Well, when you're at a swing high or swing low, a potential turning point in the market, watch what's happening internally in the bar, right? Because it's going to give you insights that, people just don't see. So the first one, right, we got this swing high here. The delta was minus 300. Okay, it's a nice big negative number. Fine. Sellers in there. But what other traders sort of dismiss or don't notice is that at one point, this bar was very strong, aggressive buying. It had 183 max delta. So it's telling you there was strong, aggressive buying, but aggressive selling took over quite strongly. It went from plus 183 to minus 318. That's the min delta is minus 318. So that's a swing of almost 500 contracts from aggressive, from the max delta to the min delta. And it closed obviously at minus 300. So it closed at quite a strong negative reading. So, aggressive sellers are in control, right? And the market sold off as expected. Now, where it gets interesting is bars like this green bar here. Early in this bar, you had a min delta of minus 319. Okay, so that's strong. It's a strong negative number. But it closed at only minus 5. Now, the max delta was just 10. So imagine, right, you had very strong negative selling in this bar, minus 300. And went from minus 300 just to minus 5. So the aggressive sellers or the aggressive buyers rather, the aggressive buyers came in late in this bar to turn it just to minus 5. Because people say, well, you got negative delta, the market should keep selling off. Well, no. If you can see that relationship of the min delta to the final delta, then you know that there was strong aggressive buying coming into the market to turn it around. And you see the market rallied a bit, and it rallied back up to, the area where you had that aggressive selling earlier. It's another example, right? This is gold. This bar right here, minus 46 min delta, right? Minus 46 on the delta is quite a strong number in gold, right? This is at 7:30 yesterday morning, right? It closed at plus 33. So if you see this, take this minus 46, and if you had minus 46 in any of these bars here, even, think of it in absolute terms, it's a pretty strong number. But it went from minus 46 and to plus 37, which is the max delta. So that's a swing of, close to 80 contracts, and it closed up near its max delta number, plus 33. So you had aggressive selling early in the bar, strong aggressive selling, minus 46. Aggressive buying came in, went from minus 46 back to even, went back to 0. Then it continued with the aggressive buying. That aggressive buying didn't just stop, it continued. And it went from minus 46 to plus 37 before finally closing at 33. what do you expect to happen? Well, you expect this market to rally, and it did. It got a nice quick rally over the next 7 or 8 bars. There's MES again. Okay, so a few things. This first bar here, right? This first bar that I got in this box. Market's rallying. It's making these highs. This is yesterday. We're making highs. And you got your first red candle here. It looked like, okay, maybe it's going to stop and sell off, right? You got the negative delta. The next bar, this bar here opens up. You got negative delta. It's at minus 247 in the delta. Okay, yeah, maybe we're going to start to sell off. But it doesn't. The market keeps rallying. If you're watching what's happening in the delta, you can easily see that there's still upside potential here. It went from minus 247 to plus 538. So that's a swing of, close to 800 contracts from the aggressive selling to aggressive buying. It closed at plus 449. So there's still more to this move. All right. So if you were long from earlier, thinking, should I take profits? Well, after seeing a bar like this, you can see that there's still more strength to this move, right? And that's, people always say, cut your losses, let your profits run. They don't really talk about that. And when you're using the order flow, and all of a sudden, hey, there's more to this move. I don't have to get out right now. I could still ride it a bit longer, right? And in this case, we're talking 5-6 more points. Now it comes up here again, a new high. There was some selling that came in. It was at minus 39. And then it flipped all the way up to 869 before closing at 720. Okay, still strong, right? This market is still strong. Then it gets to this bar here, right? This is your first sign of weakness. Plus 461 max delta. Min delta was minus 88, and it closed at 422. Or sorry, just 22. So it went from plus 400 to just 22. So it gave back a lot of that aggressive buying. It gave back almost all of it. Right? It was plus 461 on the max delta, and the final delta was just 22. So that's a sign of the first, legitimate sign of some weakness coming into the market. Then you just sort of go sideways here. You got these bars with negative delta, minus 9, minus 178, minus 218. So there's selling is kind of building up in here, right? The aggressive selling is getting a bit stronger. It does pop up and make a new high here. Okay, let's take a look at the deltas. Max delta was 203. Okay, fine. We're making new highs. Got positive delta. Then the sellers came in. Min delta minus 453. So it went from plus 203 to minus 453. Again, a swing of about 650. It closed at minus 369. So now definitively sellers are in control. All right. So what should you do? You should be looking to take your profits, finally get out, or potentially get short. All right. Next bar came in, negative delta, and it just sort of went sideways to slightly lower after that. This is the candlesticks, and if you're looking at these candlesticks, you don't know that this bar is strong. You don't know that this bar is strong, but that it's weakening in here. I mean, people say, well, you got these doji candles, etc. Yeah, you're just grasping at straws. You don't know the strength of this bar here. I mean, people say, well, it's a big red candle. Yeah, again, you could justify anything that you want, but if you have the data to back it up, then yeah, I can get short here and take it, it's about 7-8 points right here. Now, this is a 5-minute ultra bond chart, but again, this is from yesterday. I just want to dig a little bit deeper, give you some more food for thought on how you could use this in your trading. Okay, so market sold off, made this low, rallied up, sold off again. Okay, and if you're watching what was happening here, this was interesting because this market is going down, and you're seeing the aggressive buying coming in here, right? You see the buying imbalances here, 256, 1100, big, strong positive delta. Okay, even as this market was going down, people say, well, how can this market go down? You got the positive deltas. Well, look at this bar here, this red bar. It had minus 353 delta. So it's quite strong negative delta. I mean, that's why you got the red bar. But the aggressive buyers were already stepping in. You're not seeing buying imbalances yet. I mean, they haven't really popped to this market. But it went from minus 353 to just to plus 11. So basically back to even. So the aggressive buyers were showing up. Here, aggressive, you do have the positive delta of 167. Then you get to this bar here at the low of the day. Very strong aggressive buying. The delta is 1263. Max delta is 1263. Okay. So what's that telling you? It's closing on its max delta number. It's telling you it's very strong already. So you could see, even though they were selling in here, you can already see the signs that aggressive buying appeared here. All right, you're still seeing some aggressive buying in here. And obviously in this one, right before this market pops up, right, you see the aggressive buying is just so super strong. It closes on this max delta number. Even the min delta numbers are quite small, minus 39, minus 25. All right, so if you're seeing a bar like this, at your low, your strongest max delta in recent history, it's closing right on its max delta, 1263. You want to be long or short? The trade is to the upside. And you can see it rallied from basically 152.16 above 153 even. All right, that's a half a point move in the ultra bonds, right? It's a $500 move in 5 minutes. And then as you see the aggressive buying, right? Don't just take it, sit on your laurels and say, yeah, I just had a nice trade. Watch what's happening, right? The aggressive buying, 1263, 954, 195. Right? You unleashed all that aggressive buying, but the market rallied. Yeah, that's what you expected. But now you're seeing it starting to weaken. 1263, 954, 195, and then negative delta up at the swing high, minus 341. This move is over. You're not going to hold it anymore. If anything, you're going to start thinking of getting short. Okay, so that's how you could use like delta, right? It's market generated information. So pay attention to the volume of trading activity. If there's a sudden increase or decrease in the number of trades being made, right, you can see that through the delta, being an indication that order flow is changing. So let's get on to the meat and potatoes, right? Using order flow to spot opportunities in the market. Markets present opportunities every day. It's up to you to take advantage of them. But first, you need to know how to spot them, or at least where they can occur. And where you take a trade opportunity is just as important as spotting the opportunity. So have you asked yourself, have you ever thought about market structure? People seem, traders that I know that struggle. And, I used to do private coaching one-on-one for traders. And one of the reasons why a lot of traders struggled is they don't think in terms of market structure. Okay. They just blindly, oh, there's a signal, I got to take it. I got to buy or I got to sell. But you shouldn't do that, right? You should ideally, understand the market structure, because there's areas where, you're going to want to be buying and selling. And there's areas where, even though you have a signal, you're not going to want to be buying or selling, areas inside the middle of a range, right? Inside of the middle of a chop, even though you get a signal, it's not going to be a very effective trade. Yeah, sure. You might, the trade might start in your favor or go up a couple ticks, but then it's going to go and stop you out. You're going to end up getting chopped up back and forth. So what is trading around market structure? Well, that means looking for areas of market generated support and resistance, areas where the price is likely to pause or reverse. Now, these areas are generally found around swing highs or swing lows, round numbers, areas of volume or other significant order flow activity. So what I'm going to talk about is a couple today. I'm going to talk about stopping volume. I'm going to talk about something a little bit more advanced, is the value areas. Now, the value areas I'm going to talk about are in a bar. Now, if you ever looked at a chart and wondered, why did the market stop here? Right? I mean, it sort of looked like it stopped up here, came off, then it rallied back up, made a new high. Right? All these candlestick gurus, oh, you got a pin bar here, you got to get short. Okay, got short, came right back up, stopped you out. I got another one here. You got to get short. Okay, went back up, stopped you out. Right? But if you understood order flow, when you see the market come back up in here, there's a nice reason for getting short. And the volume that's being traded up in here is very bearish. But again, you have to know what to look for in the order flow. And one of the tools that we have in the order flow trader software that I explained about earlier that I created is a way to tell you when this volume is bearish or when it's bullish. And you can see here, right, it's colored red to tell you, hey, this is bearish order flow, right? Because what's happening is the market is going up. This is the point of control. It's what we call a prominent point of control. Prominent point of controls, you have bearish ones, you have bullish ones. Bearish ones are going to be colored sort of this magenta. Bullish ones will be colored kind of a light blue, a cyan color. It's a very easy visual reference. Because if you're looking at this, you say, oh, I got bearish order flow here. Now I can start to analyze what's happening, right now in the market to get short, to take advantage of it. Because if you're looking at a bar chart, people, they'll have their swing low drawn in here. Oh, if we break here, it's bearish. Well, where would you rather get short? Up in here or down here after you break this, the support area? Well, the better trade is to get short from up here, 15 ticks higher, 30 ticks higher. This is euro currency trade instead of half ticks. It's actually 30 ticks, 30 ticks higher because this is around the 80 area. This is around, the 70 area. So it's 20 tick difference. It's going to give you a better opportunity to get short, because if you're getting short down here, where's your stop? Well, people say, well, it's here. Your stop would probably be more realistically up here above this high. So imagine you're getting short one bar off the high, then 5 bars off the high when the market's already dropped 20 ticks. But this is what we call a bearish prominent point of control. Now, every bar has a point of control. Point of control is the price level in the bar with the most volume. But sometimes they're going to give you signs of bearish activity and bullish activity. And that's why we have the software to tell us when it's bullish or when it's bearish. Because again, you can see here, all these bars, just your normal point of control. There's nothing bullish or bearish about them. But there's those instances where it is very clear based on the actual order flow that it's bearish. Yesterday, bonds, right? Bonds under pressure all day yesterday. Market popped up to here, sold off. Simple. Stopping volume, right? You see that point of control? It's highlighted for you, easy to see that it's bearish, right? It's a red color. Stopping volume, what is stopping volume? Well, it's volume that is there to defend price levels, right? Traders are stepping up saying, you're not on my watch. You're not getting through this price level. They're throwing everything in the kitchen sink to stop the market from continuing higher. Okay, so yesterday in the E-minis, right, nice big monster rally. Okay, now people say, well, there's a pin bar here. Of course you got to buy it. Well, I showed you a lot of pin bars just now that failed, right? There's a pin bar here that failed, right? There's a pin bar here that failed. What made this one, what is this one so special? The volume, right? This is the thing. People will say, well, there's price rejection here. The market went down and traded that price and it rejected it. Well, what's your definition of price rejection? Actually, what you have here is absorption, right? You got heavy volume down in here, and you can see it in the point of control. You see the point of control is blue, right? It's a prominent point of control. It's a bullish one. And it's telling you heavy volume is trading down here. Traders are stepping up to absorb whatever selling is happening in that market. And if you knew that there was absorption down here, as opposed to, oh, I just got a pin bar, I got to buy it blindly, you're going to have more confidence in your trading, right? And this was a monster move, 39.30 all the way up into the 70s. Almost a 50-point move there. And that was really the icing, the cherry on top, right, is that volume, right, that point of control there telling you that, there's absorption going on, there's price defense. People are saying, not on my watch. Now, when you think of price rejection, Price rejection would be the opposite. It'd be very thin volume, but this is heavy volume. Okay. And like I said, people will say, well, there's a pin bar here, right? That's what caused this market to go up. Well, fine. Here's a couple other pin bars here. One here, one here. But there's no stopping volume involved here. Just your normal point of controls. But these ones, yeah, I mean, technically the market went up a couple of points, but it's not the 70-point move right here. Sorry, 50-point move. So that's the difference that order flow is going to help you see in the market, right? It's going to see where there's stopping volume in the market. Because when there's stopping volume, when there's price defense, that's basically a line in the sand. Traders are saying, not on my watch. You want me on that wall. You need me on that wall, right? They're stepping up to the plate to stop any movements from going down. So by trading around market generated levels and market generated information levels, you can better understand where the market is likely to go next and make more informed trading decisions. Of course, the market structure can and will change over time, so it's important to stay aware of the latest developments. And again, just to reiterate, what is market generated information? It's data that's created as a result of actual trading activity in the market, not orders going in and out of the order book, right? Not orders that are sitting in the market that may trade towards, may not trade towards. It's actual traded volume. So market generated information include things like price changes, trading volume, and order imbalances. Now, this next concept I'll talk about is the importance of value areas, and it's a more advanced concept for traders to understand. Now, if you're familiar with volume profile, market profile, you're familiar with the term of a value area, right? It's the area on where majority, usually 70% of the volume occurs, right, of the trading day, because volume profile, market profile tend to look at trading days. But with order flow, you can actually take it on a more micro level, on a bar by bar basis. Now, a lot of times you see charts. Market pulls back to a certain level, stops, and then continues on in its direction. Okay, if you sort of draw retracements here, it's not really a 50% retracement. It's not a 38. People say, well, maybe it's a 61 from this level. They're always trying to redraw their retracement levels to sort of fit their narrative, right? I mean, it might be a 38% retracement from this level here to here, 61% from here to here, 23 from here. Oh yeah, see, it's converting. Well, yeah, come on, man. That you're really just pulling at straws. There's got to be an easier way. Now, at that dip area here, yeah, we have a bullish prominent point of control that's formed. Now the thing is, bullish prominent point of controls, you don't really know about them until they form, right? What if you had a way to see a level where the market might pull back before it actually pulls back here, right? It's nice to get that prominent point of control in this bar, but if you know that there's a level coming out from right in here, yeah, that's gold, basically. And by using the value areas, you can see those areas where there was support based off of previous market activity, right? Right here, right? This is that little place it pulled back to. But in here, this is the value area in a bar, right? And you can see it being drawn out here. It's what we call an abandoned value area where the next bar doesn't trade into it. Now you have another one up here, okay? And the markets did pull back here and just, you went 1, 2, 3, 4 bars into it. This one held better than this one. But you know that when the market is trading up in here, it's got potential to come back to 05. It's got the potential to come back to 02. So imagine you're just throwing a bid at 05. Okay, got stopped out, throwing a bid at 02. You're filled, right? And then the market went from 02, right in here, all the way up to 12. So what is happening is the market is referencing a value area from earlier. This is the value area from earlier that it's referencing. Now, again, software, that's the beauty of software, is it can draw out these areas that are left abandoned like this one here, this one here. So value areas that are abandoned, meaning the next bar did not retrace back into it, often act as magnets. Now, there's different ways to trade these abandoned value areas. Number one is for the market to repair them. What that means is for the market to come back to that level, okay? The other thing is to go with it, right? After the next bar abandons that value area, you know that volume is transitioning higher, right? And very early in this training, I said when markets, when volume is when volume is picking up, that's when the market tends to move, right? And more importantly, when volume is picking up in a direction that that the market is probably going to continue in that direction. So for example, right, go with the abandoned value. It's abandoned value here, abandoned value here, abandoned value here. You don't know, of course, until the next bar closes that it didn't retrace back in. But if you went with it here, you got a little move here, pulls back, it's holding, then more abandoned value. Again, you just go with it, right? So it's a great go with trade here, right? Abandoned value, then it takes off, right? Here's your value area that's abandoned because most of the time it's going to overlap or it's going to trade back into it. Again, now, hang on a second, I gotta drink some water. Now the key is, you understand that as value is transitioning one way or the other, then you know that buyers' perception of the market has changed because they're more willing to pay higher prices because they're already accepting that value is moving higher. Now there's going to be times where it just goes sideways like this, right? It came off, it's kind of holding here, just sort of going sideways and comes back in and it failed, okay? I mean, it's not the end all be all that, you got an abandoned value area, it's going to forever hold. Like here, it came off, it's holding, it comes back up into it, just kisses the edge. This is what you see a lot of times, where it just sort of comes back in, kisses the edge, and then makes its move. Now, when you start looking at longer term charts, this is a 5-minute chart. Most of the charts I showed you earlier were just simple 1-minute charts. Whether you could use it on tick-based charts, you could use it on range-based charts. I don't think you can't use it on Renko charts. But when you start going out into a little bit longer time frame, 5 minutes, it really becomes a bit, in my opinion, a bit stronger, right? Here's a nice one, right? Abandoned value area, nice move down 103 down to 102.75, or even here is 102.80, where you had a support line from earlier, right? You see how this market came down to this area, and then it's kind of holding, it's kind of going sideways, right? Actually, so over the next 25, 30 minutes, it was just going sideways in that area. This was your support area. So if you're short from up here and you start coming into this level and it's going sideways, you know that, okay, yeah, I could take profits already. 15-minute chart. Okay, same thing, right? MGI support level, market generated information. Market went up, nice move up, right? Even here is another support level. Market came off. You got a resistance area up in here, this red area, this red area, this red area. Well, look what happens. Market went up, started coming off. It came down to the support area, right? Then you got resistance here. It came right into the resistance, right? Now you got a new resistance level here. Market sells off. Where does it come to? It comes right to the support area. I mean, it doesn't get any, in my opinion, any simpler than that. This is Apple stock. Okay, I had to scrunch it up. I mean, I'm not concerned with what the footprint volume numbers are in this case, but I scrunched it up to show you, right? Market rallied, right? You got your abandoned value areas here. 1, 2, market rallies. Well, where does it stop? It stops right up at the area where you had your previous abandoned value area. All right, so if you're long from here, you understand why it stops here, right? That's really the whole key in trading, is understanding why markets move. And more importantly, why markets stop. Why did it stop here? It's coming down, it's testing this support area right here. Okay. Apple again, right? This is a go with trade, right? It just came back here, just kissing the top, and then it went for it, right? Then it made its run. So Apple again, right? Band in value area up here, market sold off. Where did it sell off to? The area where you had the market generated support right here, the previous value. Then the market rallied from this area to where? Here, where you had your resistance level. I mean, it's. I wish I could say every single chart is going to be as beautiful as this. It's not. There's times where it just sort of it can blow through it. But if you know where these areas are beforehand, right, it's going to help you manage your trade a lot better, in my opinion. So hopefully you can start to see, the benefits of using order flow, right? Because, at the end of the day, that's what you want to do, right? You want to use order flow to help your trading. So over the last 45 minutes, actually, it's more like the last hour, I've covered a lot of ground, right? You've learned the basics of order flow trading, and you've hopefully seen how it can help you make better trading decisions. You've also learned about some of the key tools and resources that are available to order flow traders. So hopefully you'll agree that it's been time well spent, right? I certainly think so. I like to think, that you've come away learning something. But again, in just a short amount of time, you've learned a lot about a complex topic, right? Order flow is it's not basic, right? It's not a simple thing. You do need to wrap your head around some key issues. So I can't cover everything in a quick training session like this. I mean, I wish I could, but there's just so much more to learn about order flow trading. But I hope that now you have a good understanding of order flow basics. But if you're interested in learning more, I have a very special offer for you. It's the Orderflows Trader 5.0. Now, you've seen some of the tools like the value areas, the imbalances, the multiple imbalances, things like that. And really, what it is, think of it like this. Right? Have you ever wished you get inside the minds of professional traders and see what they're thinking? With the Orderflow Trader version 5.0, I'm on the fifth version of the software since we released it in 2015. You can do that, right? This is software that takes my knowledge of trading order flow and puts it into a program so you can see what institutional traders are doing in the market. So with this valuable information at your fingertips, you're going to be able to make smarter, more profitable trading decisions. Now, I do realize, right, many traders think that having the right software is all they need to be successful in trading. However, this could not be further from the truth. If you don't know how to use the software, it won't do you any good. That's why I focus on providing education on how to trade with order flow. I want my students to be successful, and I know that starts with giving them tools they need to understand the markets. Once you have a solid foundation, you can begin to place trades with confidence, and that's when the real success starts to happen. So not only do you get the software, but you get educational courses, right? You're going to get my order flow trading course, which normally sells for $297. You're going to get it for free. There's 20 lessons in there. It's the first course on trading order flow that was on the market. I mean, a lot of people have actually taken my courses and copied them, rewritten them, and tried to pawn them off at their own. But this is I'm the source for a lot of this information that's out there nowadays. You're going to get it for free, right? The order flow trading course. But more importantly, you're going to get the order flow inner circle video series, which honestly you can't buy anymore. I don't sell it. I only make it available with the software. And when I did sell it, it was close to $500. But there's 56 videos on advanced order flow tricks, tips, and analysis. So you start adding it together, right? It's starting to add up, right? It's almost $899 for the software, $297 for the order flow trading course, $497 for the inner circle video series. That's almost $1,700. But again, you're not going to pay that today. Now, I realize it's one thing to learn from videos and books, the training courses, etc., but it takes discipline and it takes commitment. And what I've found very helpful to traders is live training, where you can ask me questions. And so for the last 3 years, I've been hosting live user sessions for all users to join where I drive home what I saw in the order flow the past week, and you could ask questions about areas where you may be struggling with your analysis. My thoughts on markets, my thoughts on parts of order flow, etc. It's up to you. It's a free um, forum in the sense that you can ask whatever you want. And the other day, today's Thursday, I just had it on Tuesday. I spent maybe the first half talking about some interesting things I saw in the order flow, in the second half answering questions ranging from hey, I look at this market, what do you think is useful to trading ultra bonds, right? Or what's a good way to use imbalances? There's so many different ways. Now the archives, if you can't attend live, it's recorded, so you could watch the replay. The archives have actually, it says 157 here, but it's much more than that. It's over 170 already. And there are people out there that sell you software and then expect you to pay extra to learn how to use it. What? You're making an investment to learn how to trade. You don't want to keep paying bits and pieces, they're nickel and diming you to death, right? But what I discussed today is just a small sample of the kinds of analysis I talk about on a weekly basis in the live group training, and what can be found in my Inner Circle video series. I go into much more detail, though, about aspects of trading, from technical analysis to fundamental analysis. I also talk about the different trading strategies I use and how to adapt them to changing market conditions, and much more. So if you're serious about trading, then I highly recommend you get started now. So to get started now, you go to orderflows.com/oft5. Now, in these weekly sessions, you're probably going to learn more than you ever thought possible. I put the link in the chat. It's this link down here, orderflows.com/oft5.html. And when you type that into your browser, it takes you to this page. Okay, and you're going to have to scroll down. I mean, there's some videos you could watch there, some examples of how you could use the software. And you just click this button here to get started. Click here to buy now. You're going to get lifetime access to the Orderflows Trader 5.0. Any upgrades are free. We do have an upgrade coming out later this year. And, I've got people that have been using this since we first launched it in 2015. They're still using it 7 years later. They've gone through all the upgrades. And, they're just happy to be better traders. So you can get access to the Orderflow trading course, the Inner Circle video series, weekly live group trainings, and I've even got a special bonus, which I'll talk about in a minute, the Orderflows playbook. Now, when you click on this button, it takes you to PayPal. PayPal processes your payments. Now, all the download information, license tokens, course logins, etc., is sent to your PayPal registered email address. So whatever email you use to log in here is the email it will go to. So check that. And again, if it doesn't hit your inbox, check your spam folder. Now it does, since I do create, all these course logins, right, because we do have a lot of bonuses, it does take time. So, give it, we're usually pretty quick. The turnaround is usually within, an hour, but, for whatever reason, sometimes it takes a little bit longer to get the email from PayPal that you purchased. It could take a couple hours, but just bear that in mind. I mean, some people, you don't get it till the next day. Now, all you got to do is just a one-time payment of $7.49. There's no recurring monthly payment. There's no, I don't hit you up, a year later with another payment for $7.49 or charge you $29 a month forever that you got to cancel your credit card and then still getting charged somehow to your bank account. You got to close that bank account to cancel. No, none of that nonsense, right? It's just a one-time payment. Now, you will obviously have to pay data fees, NinjaTrader fees. My software runs on NinjaTrader 8. But again, it's just a one-time payment, $7.49, very affordable. Now, as a special bonus for Investors Expo people, you're going to get the Orderflow playbook. Normally, it's $297. You're going to get it for free. It's a short course on Orderflow. It's a little bit advanced topics. And also in there, there's about, I think it's 10 or 11 additional trade setups that you can learn about and look for in the markets. So to get started, go to orderflows.com/oft5. Again, the link is in the chat. What you're going to get is the Orderflows Trader 5.0 Orderflow trading course. It's valued at $297. Orderflow Inner Circle valued at $497. Orderflow Live Weekly Group Training. What's that value? That's like minimum $200 a month. I've seen people, they have these quote trading groups and they charge $197 a month. Well, for what? Just spend all this money on your software. You should make it for free. The Orderflows playbook value is $297 plus the software. The Orderflows Trader 5.0 and free upgrades when they happen. It's $899, but you're not going to do that, right? It's just going to be $749. Now, I did write a book on trading order flow. Okay, it's called appropriately Trading Order Flow, and that was when I sat down to write it. I thought this is going to be my contribution to the market trading world, and it's about 150 pages. Well, I'm going to show you how to get it for free. Just go to this page, orderflows.com/book.html, enter your name and email address, and click submit. It will take you to a page where you can download it. You're not going to get the actual hardcover book. You're going to get a downloadable PDF so that you can, download it to your phone, to your computer, print it up, do whatever you want with it, make your notes. So just go to orderflows.com/book.html to get started with the book, and to get started with the software, go to orderflows.com/oft5.html. So just remember, right? In the end, we only get the chances we didn't take. When a couple of years ago when COVID hit, I know a lot of people said, yeah, you know what, I'm going to do this, I'm going to do that. And they never took action. They never did anything. Right? Then a year later, 2 years later, they're right back where they started from. And the same things with trading, right? You want to become a better trader, you got to take that first step. You got to take action, right? And I try to make it as easy as possible for you to succeed with trading, specifically with trading order flow, not just by having, in my opinion, the best software out there, but also by having the best education out there, right? So again, get started. Just go to Oft5, orderflows.com/oft5.html. So just a quick question here. Hey, Mike, I don't know who this is. Just says, asking this member, I'm a customer of Orderflow Software 3.0. Can I upgrade? Yeah, you should already. I've sent you links. Check your spam folder, right? Because whenever we do an upgrade, I usually send about 10 emails, like an email a day for the first week, about the upgrade. So sometimes it goes to your spam folder, but just send me an email, right? If for some reason you aren't getting my emails, because sometimes, especially if you got like a Yahoo email, it does send a lot of emails to the spam folder. Gmail is much better. Is there a trial version? Simi asks. Sorry. No, there's not a trial version anymore. We used to have it, but then it was just getting abused by people. So, I mean, honestly, our prices are pretty reasonable that we don't, it's not overwhelming. Yeah, unfortunately, it only works with NinjaTrader. That was the software that years ago, I mean, again, going back into 2013, 2014, 2015, as far in terms of, as a retail trader, there wasn't as many platforms as you have out there now. And, the programmer, I love my programmer. He's the greatest one out there, in my opinion, because especially now, I could just go to him, sort of sketch out ideas and say, hey, this is what I'm looking for. And a couple of days later, he's got the solution for me, in terms of, programming the stuff. There are knocks against NinjaTrader, but honestly, it's a stable platform as long as you're not overloading your system. What type of data feeds? Okay, so if you are going the NinjaTrader route, if you're getting my software, you're going to go through NinjaTrader, of course, but you just need level 1 data. You don't need level 2 data. So what I would suggest is, especially, if you're not actively trading right now, or maybe you're trading on a different front end system with a different broker, the way to get you can get data for a very inexpensive fee, $60 a month, more or less, I'm paying for. I've got CME, CBOT, NYMEX, and Eurex. I've actually got level 2 data for all. But if you're just going to level 1 data, because I pay like $60 a month, $65 a month, for real-time data that's coming through NinjaTrader brokerage. Now, what some people do, I know that trade through a different front-end system with the different brokers, they just open up a simple account at NinjaTrader brokerage, throw a couple $100 in there. Because if you were to pay for data separately, one exchange CME is like over $100 real-time exchange. But again, best case scenario, you'd trade through NinjaTrader brokers. And I'm not trying to pimp them out saying they're the greatest brokerage ever. I don't get any feed. I don't get anything back from them for it. But for me, they've been fine. Right, I've never had any issues with them. So that should answer your question. So again, if you just had simple level 1 data for CME, CBOT, COMEX, NYMEX, you're going to talk around $50 a month for those 3 exchanges real-time data feed. So again, everybody, to get started, just go to orderflows.com/oft5. The link is in the chat. So hopefully, again, you'll learn something. To get my book, go to orderflows.com/book.html. And I hope to see you guys on the inside. So I'll just leave it there. Thanks again, Anna, for having me. And it's always a pleasure to talk to your crowd. So bye-bye, everybody. Have a great rest of your week.